In this video, we're going to discuss the process of leasing a car, as well as some reasons people choose to go this route instead of buying a car. We're also going to discuss some pros and cons to both options, leasing versus buying. But in this video, we're going to mainly focus on the leasing process and what you can expect. So stay tuned for this valuable information. If you're new to the channel, consider subscribing and turning on the notification bell as I'm posting valuable new information at least twice a week. Alright guys, so do you have car fever? Are you ready to enjoy that new car smell? I don't know about you, but I do find that new car smell quite addicting. But anyway guys, a new or used car is one of the most significant expenses that you and your family can incur other than housing costs. If you don't want to deal with an auto loan or find it too difficult to save up for a full price of a car, you may want to consider leasing a vehicle, although again, it's not for everyone. So leasing a car allows you as a driver to experience new car luxury and reliability with a lower monthly payment than you would with a car loan. However guys, that does not mean that leasing a car is less expensive than buying a car. The lower lease payments will cover the cost of depreciation on the car and the cost of financing, but the payments do not allow you to build equity or ownership in the vehicle over time. So Joe, when you lease a car, you're essentially paying to drive the car rather than to own it. During the leasing period, which is usually 12 to 48 months, you pay for the right to drive the car up to a certain number of miles. When the lease is up, you give the car back to the dealership. Again, you are paying to drive the vehicle. Now, when you take out a regular conventional auto loan, you own the car debt-free at the end of the loan. When you lease a vehicle, you will not own the vehicle you lease unless you exercise a purchase option, which often involves a new loan at the end of the lease. Most leases limit you to driving somewhere between 10 to 15,000 miles per year. For example, a 3-year lease may have a mileage allowance of 36 to 40,000 miles. If you go over the allowed mileage, you will have to pay for the excess mileage at the end of the lease. Alright, so let's discuss some costs associated with leasing a vehicle. Again, when you lease a vehicle, you're gonna have some upfront charges, monthly payments, and end of lease charges. So when you lease a vehicle, you don't make a down payment in the traditional sense. Instead, the money you pay up front is called a capital cost reduction. So the capitalized cost of a leased vehicle is basically the purchase price of the vehicle plus anything that's added to the contract. If you trade in a vehicle or put money down, you reduce the capitalized cost. Alright guys, so when you pay money up front, you get the benefit of lower monthly payments during the lease. With that being said, Joe, industry experts often advise you to limit the amount of money that you pay up front for a lease. The monthly payment is the amount you'll pay in and out for as long as you lease the vehicle. Just so you know guys, your monthly payment will typically cover the following 5 costs. So number 1, depreciation. This is the amount of value the car loses due to wear and tear over time. Number 2, service and insurance payments. It is common to pay for service contracts, car insurance, and warranties as part of the lease payments. The total cost of these expenses are baked into your monthly payment. Number 3 is interest fees. In a car lease, the interest is called a money factor. So the money factor you see is very tiny. So you multiply the factor by 2,400 and you'll see your annual percentage rate on the lease. So a money factor of 0.005 translates into a 12% APR. Number 4 is use tax. When you lease a vehicle, you usually pay a use tax rather than a sales tax on the vehicle. And number 5 is gap insurance. The finance company may require lessees, that's you, to get gap insurance, which will protect the lender if the leased vehicle is damaged or stolen and your regular insurance doesn't cover the full replacement cost. Since many leased vehicles are initially underwater or upside down, lessors may require you to buy this insurance so that the vehicle is protected. Now let's discuss some options you have when your lease is up. Number 1, you can exercise a purchase option at the end of the lease. So you as the driver will have the option to buy the vehicle. Buying the vehicle is a great option if the value of the vehicle is more than the end of lease purchase price. If you don't have the cash to buy the vehicle, you can take out a loan to buy it. Number 2, you can just walk away from the vehicle. Just give them the keys and you're done. So at the end of the lease, you can settle your account and just walk away from the car. You have no obligation to buy the vehicle or lease a new one from the dealer. Now this might be the right option for you if the vehicle is worth less than the purchase price of the vehicle. And finally, number 3, you could start a new lease. Dealerships won't always offer new lease deals, but many will offer certain incentives to get you as a driver to sign on to a new lease. So when you return your vehicle, you have a certain amount of negotiation power to sign on to a new lease if that's what you decide to do. Alright guys, so in my early to mid 20s, I used to always lease cars because I was obsessed with luxury cars, specifically Mercedes-Benz. I'm a Benz guy. I always wanted to change cars like every 2 to 3 years, and I decided to lease back then. Now looking back, I realized had I decided to buy a used vehicle that was less expensive and invested that money, I would have more money saved for my retirement and in my investment accounts. One thing people can't forget, and myself included, is opportunity cost. So opportunity cost means this is what else your money could be doing for you. Now Joe, in terms of money spending, when you compare a lease payment to a car payment, the lease payment is usually lower than the car payment. However, if you drive year in and year out for decades, leasing a car is the most expensive way to drive. Because when you lease, you are constantly paying for depreciation on a new vehicle. Vehicles depreciate more in the first few years of driving them than any other time. Leasing a car can make more sense than buying if you're someone who must always be driving the latest car model. If, for example, you plan to upgrade cars every 2 to 3 years, depreciation could make traditional car ownership unrealistic for you. Now, switching to a new car every couple of years is going to be an expensive decision no matter how you spend it. As I said earlier, guys, I used to lease all the time, but my last 2 car purchases have been traditional buys. One car I paid for cash and the other was financed and is now paid off in full, and I still have both of these vehicles. So Joe, leasing a car is convenient, but it can be really expensive. I would say that most people who are working on building their income, building their wealth, should not be leasing cars. It simply doesn't usually make sense from a financial perspective for most people. Now, saving cash to buy a used vehicle is usually the most affordable choice. Of course, buying a sensible and reliable new car that you can pay off in 4 years or less can make sense for you too. So what are your thoughts about car leasing? Have you leased a car? Please leave your comments and feedback below. If you found value in the video, please be sure to hit that like button and share this on your social media. Do not forget to subscribe and turn on the notification bell for new content updates. Thanks for watching, and until next time.